So anyway, it's a great pleasure to be here and to talk to you about what drives booms and busts in value. And this is joint work with Stefano Giglio at Yale and Christopher Polk at LSE, both people that I've had the pleasure of working with on a number of papers over the years. The question we're asking is, why is value investing so risky? What is it that's going on that makes value investing sometimes successful and sometimes disastrously unsuccessful? So first of all, what is value investing? I suspect everyone in the room knows quite well, but the idea of value investing is that you buy stocks that appear cheap on the basis of accounting measures. And there are various ways to do that. Of course, the standard academic implementation sorts stocks on the book-to-market ratio to construct the famous Farman-French factor HML. And HML, one might expect to deliver a good return. And what's the argument? The underlying argument is that if the book value of a firm is a good proxy for its expected future cash flows, discounted at a constant rate, if that's the case, then by buying stocks that are cheap relative to that, you're buying stocks that have a high discount rate or equivalently a high expected return. So it's the logic of the kind of Campbell and Shiller analysis going back to the late 1980s. Now, of course, that's a big if. It may or may not be the case that the book value is a proxy for expected future cash flows. Even if it used to be the case, maybe less so now. There's a lot of arguments about that. But for now, let's just take as given that we're going to try investing on this basis of book to market. So a first observation is that strategy is risky. The annualized standard deviation of HML, which remember is a long-short portfolio of stocks, is about 12% over the last 50 years or so, since 1963, the last 60 years. And it's even a little higher in the last 30 years since 1990. So that standard deviation is substantial, even relative to the standard deviation of the aggregate stock market. And one can think of large drawdowns when value investors did particularly badly. The early 1970s, the so-called era of the Nifty 50 growth stocks. Again in the early 1980s, the early 1990s, of course, famously the tech boom at the end of the 20th century. And then the downturns, the two recent downturns of the global financial crisis in 08-09 and the COVID-19 pandemic. So the question we're asking is, where does this risk come from? In some sense, the movement of HML is cross-sectional variation in the returns on different types of stocks. Now, does that tell us something about what's going on in the aggregate economy? Or is it just somehow a bottom-up aggregation of unique shocks to different parts of the market? Now, standard asset pricing theory would suggest that when a cross-sectional factor is priced and carries a risk premium, it must be correlated with the marginal utility of investors, or the stochastic discount factor, and therefore you'd think it would be telling you something about the aggregate economy. But what exactly is it doing? Okay, so that's the question. Now let's start with two very, very, very basic facts. First is, value risk is nothing to do with the beta of HML with the aggregate stock market. HML does have a beta. It's slightly negative. Why? Because value stocks in the long leg have lower betas than growth stocks in the short leg. But the beta of HML is close to zero in absolute value, and certainly the R-squared of a market model regression for HML is just trivial. It's not telling you anything very much. A second point to keep in mind is that the risk of HML comes more from value within industries than from value across industries. I'm going to show you how we calculate those components, but the within industry or intra-industry component has a standard deviation of about 10% a year, and the cross-industry piece has a standard deviation of about 7% per year. So a lot of what's going on is going on within industries. Now, I'm going to illustrate these facts using some plots of historical returns, and what I do for these plots is I smooth them to make them readable using an exponentially weighted moving average with a 2-year half-life. So in a plot like this, whenever you see a line that is high, that's saying that over the last 2 years, roughly speaking, the returns have been very high. Okay, so the red dashed line here is the aggregate stock market, the return on the market. So the red dashed line is telling you the history of the booms and busts of the aggregate market. So you can see the bull market of the 60s, the bear market of the 70s, recovery in the 80s. You see at the end of the 20th century, you see the tech boom, and then a collapse, and then you see the credit boom in the mid-2000s, and then a collapse, and then you see the very strong returns in the 2010s, with at the very end a dip, which is the COVID-19 pandemic crash and then recovery. All right, so that red dashed line is the market. The black line is HML, and you can see that it too has booms and busts. I talked you through the dates of some of the busts a couple of minutes ago, but just by looking at the red and the black line, you can see that these returns are not strongly correlated. In some periods of time, it looks as if HML and the market are moving opposite one another. Other times, they move together, as for example in 08, 09. And overall, it's a very weak correlation. Now this figure 2 from the paper, is showing the two components of HML that I mentioned, the intra-industry piece and the inter-industry piece. The black is the overall HML, the green line is the intra-industry piece, and the red line is the inter-industry piece. And you can immediately see that if you had to pick one of these things as a proxy for the black line, it would be the green line. In other words, the main driver, the thing that's most important for HML is actually the intra-industry piece. Okay, so what do we do in this paper? What am I going to talk to you about beyond these basic facts? First of all, we're going to try to look at value risk through the lens of an intertemporal CAPM of the kind that I've worked on in a number of papers over the years, and most recently in a paper with Gilio Polk and Bob Turley, CGPT 2018. That is not short for ChatGPT, that is our paper. And in that paper, we talked about 3 different shocks that come along and affect the aggregate stock market. The first is cash flow news, which you can think of as innovations to the present value of rationally forecasted cash flows, discounted at a constant rate. Or equivalently, you could think of that as permanent shocks to stock prices. If expected profits go down, that's a permanent hit. The second component is discount rate news, which is innovations to the present value of returns. It's kind of a long run average discount rate. And you can think of that equivalently as transitory moves in stock prices, because if the market goes down because discount rates have gone up, well, discount rates are high. That means expected returns are high and the prices are going to recover. And then finally, the innovation in CGPT relative to earlier work is that we also thought about variance news, which is innovations to the present value of the variance of returns. So volatility, except it's squared volatility, it's variance. It turns out this approach has much better explanatory power than the CAPM for both HML and its intra-industry component, although much less so for the inter-industry component. Now, we implement this model in 2 different ways. The first way is what we've done in prior research, where we have a quarterly vector autoregression, and we use a long sample to estimate these coefficients and construct the news terms, and then we combine that with betas, which we estimate in the modern period when a value anomaly exists. In other words, since 1963. So that's stuff that is kind of out there in earlier parts of this research agenda. But the new thing in this paper is that we come up with a way of combining daily and quarterly data so that we can estimate the news terms at high frequencies and really track over short periods of time what these shocks coming into the market are doing. And that's a contribution of the paper, and I'll show you how we can apply that to understand what happened in 2020 when If you remember, the market kind of collapsed in March and April and then recovered. So what was going on there? What we're going to show is that in that pandemic, actually in 2020, what moved the market really was the news about cash flows, beliefs that profits would be low for a long time as the market went down, and then a revision in beliefs to believe that in fact profits would recover as the market went back up. Now other things were going on. Discount rates were moving and there was a lot of news about risk, but it just turned out that those other things, the discount rate news and the variance news, roughly canceled out so that the movement in the market was almost the same as the movement in the cash flow news. So those shocks turn out to be what was driving HML and intra-industry HML in the pandemic. But for inter-industry HML, a very different story. It was, in fact, shocks to sector-level earnings, industry-level earnings, that are orthogonal to the market. So I'll get to that later on. Now, what don't we do in this paper? We're really not talking about average returns here. We're focused on risks. We're asking the question, ex post, when you see realized returns, can you interpret them? Where is the risk coming from? What does it mean when value does well or badly? Ex post. So the focus is really not on the average return, although we do actually extend the evidence in CGPT that the ICAPM is a good model for pricing HML, because we find that intra-industry HML has both greater exposure to the risk factors, which the ICAPM says should be priced, and also higher average returns than the other piece, than the inter-industry piece. So that's just a small additional piece of evidence, not perhaps a big deal. Second point is that value investors have been pretty miserable since the global financial crisis. The average returns have been low. The 2010s has been called a lost decade for value investors. And then there was a sharp drawdown in 2020, although then there was a recovery in 2022 and so forth. So we don't address the question of whether the lost decade is the result of a structural shift in risk premia or simply a sequence of unfavorable residual shocks. That's an interesting question, but not what we're getting at here. And finally, there are, of course, massive and very important literatures on both value investing and factor models more generally and intertemporal asset pricing. So for the sake of time, I'm not going to try to do any literature review in this talk. So outline, I'm going to show you this quarterly approach to the ICAPM following CGPT. And then I'm going to show you how we decompose HML into these two components, intra-industry and inter-industry. And then we'll try to explain the movements of HML and its components using the CAPM, in other words, just market shocks, and the ICAPM, which is these three shocks. Having done that, I'll show you how we extend the approach to the daily frequency. I'll take you through the COVID-19 pandemic case study. And then at the end, if I have time, I'd like to talk about other anomalies besides value and at least gesture at research that we hope to do in the future that will shed more light on other anomaly returns as well as value. Okay, so what is this quarterly VAR model? So we write down a model which is a heteroscedastic vector autoregression for a state vector X. So there's a transition matrix which is big gamma in that equation, and then there's a vector of shocks. And you notice that right before the vector of shocks, there's sigma t, which is a scalar. That's a standard deviation, which is scaling it's the volatility of all shocks. It moves volatility up and down in proportion across all shocks. Then the square of that thing, sigma squared t, is going to be in the VAR. The first element of X is the aggregate market return, and the second element is the variance of aggregate returns. What we do then is we use this econometric model to forecast returns and variance, and then we calculate we calculate the expected present discounted value of all those forecasts every quarter, using a discount factor rho, which comes out of our linearization of returns. And then discount rate news is the innovation to the return forecast. Cash flow news is whatever else is happening to the return. And variance news is the innovation to the variance forecast. So that's in words what we do. If you want, nasty looking algebra, eta here, the vector eta is it's sigma u, it's the heteroscedastic vector of shocks. And then we know what gamma is. We have our linearization parameter rho. The rho gamma I minus rho gamma inverse thing, that's just the present value of forecasts. It's actually the present value of the revisions in forecasts because eta is shocks. And then E1 prime picks out the first element. That's revisions in forecasts of expected future returns. That's what we call discount rate news, or NDR. The second equation shows you cash flow news, which is just take that out of returns. Whatever's left is cash flow news. And then finally, variance news, we're forecasting the second element in the state vector, and we're calculating the innovation in the forecast. All right, so we've got these three news terms, NDR, NCF, and NV. How do we do this? What state variables do we use? What's the sample period? So we have the log real return on the crisp valuated index. We have the realized variance of daily log returns within each quarter. We have the CAPE ratio, which Bob Schiller and I argued for years ago as a good long-term predictor of stock returns. We have a yield spread from the term structure of Treasury interest rates. And then we have a couple of other financial variables. We have the value spread for small stocks. What's the value spread? It's the difference in the book to market of the cheap stocks versus the expensive stocks. It's how much of a difference is there actually? How cheap are the cheap stocks relative to the expensive ones? And that turns out to be a good predictor of market returns when that gets very wide, then we expect market returns to be low. And theoretically, that is consistent with the idea that the ICAPM is explaining the value anomaly. In other words, HML is actually then, or small stock HML particularly, is actually telling us about what are the revisions in these discount rates. Finally, that we include the default spread between low-grade and high-grade corporate bonds, and that we include because it's a good predictor of long-run variance in the stock market. Why should that be? Well, think about it this way. Corporate bond investors have it's as if they have a short position in volatility. Volatility is good for equity holders. It's bad for creditors. And these are long maturity bonds. So it's relative to something like the VIX. This is a much longer maturity, low frequency estimate of volatility. And of course, it's available, going way back, whereas VIX is only, something that exists in recent decades. So with these state variables, we then estimate the VAR over the longest period we can do, going back to the beginning of the CRISP data in 1926, because accurately estimating return dynamics requires a very long sample period. And then the focus of the paper, however, is going to be the period 1963 onwards when the CAPM fails to price HML. Okay, so what do we get out of this? I'm going to show you, instead of discount rate news, I'm going to show you the negative of discount rate news, because declining discount rates drive up stock prices. So the negative of discount rate news, when that goes up, that's a sign that the market is going up because of sentiment. Think of minus NDR as something like investor sentiment. Now that discount rate news has a volatility of 8.4% quarterly. That's more than cash flow news, which is only 3.5% quarterly. The cash flow news is positively correlated about 0.4 with negative discount rate news. That means that when there's good cash flow news, typically discount rates fall, and if you like, investor sentiment drives up stock prices by more in response to the cash flow news than would be the case if discount rates were constant. You could call that overreaction relative to a benchmark in which discount rates are constant. We find that cash flow news is negatively correlated with variance news. So return variance tends to increase in bad times when corporate profits are low. But discount rate news and variance news are only weakly correlated, which is saying that there's no strong association between expected return and risk in the stock market. Actually, this is something that many people have found over many years, that, you know, the theoretical expectation that expected return for the market as a whole and its volatility should line up. Well, not really. They seem to move independently. So these patterns are qualitatively similar to what I've found in earlier work in CGPT, although the correlations are larger in absolute value in this implementation. So, you know, here's the history of the news terms. Perhaps just visualizing this will help. Start with the green line. That's cash flow news. That's what the return would be if discount rates were constant. It would be more stable, but it would be plausible perhaps because you had strong profits in the 60s, low profits in the 70s, some recovery in the 80s, a much stronger a period of very strong profits in the 90s, and again in the mid 2000s. And then, of course, very sharp downturns, you know, in the 70s, the early 90s, the global financial crisis, and you can see a short-lived drop in cash flow news in 2020 in the COVID pandemic. Then the black line is the discount rate news. Think of that black line as some sort of measure of investor sentiment. When it's high, investors are willing to buy stocks at high prices and low expected returns. So what you see is that sentiment was very depressed in the 70s, and then there was the great bull market of the late 20th century peaking around the turn of the millennium. And then there was the tech wreck in the early 2000s, and then the credit boom, then the global financial crisis, and then another period of very strongly increasing sentiment in the 2010s. Then finally, the red line is the variance news, and you know, it's less volatile than the other two things, but you can see that the variance news was generally that things were quieting down in the 60s and 70s, but you saw an increase in risk in the late 90s. You saw a big spike in risk in the global financial crisis and another very sudden spike in the COVID-19 pandemic. All right, so I think these should be sort of familiar. These reflect well-known patterns in the history of the US stock market, and I hope you find them sufficiently plausible so that it's interesting to ask, what are these different things, the black, the green, and the red, what do they do to value? So I want to look at these two components of HML that I was telling you about. And to do that, here's the recipe we follow. Our basic approach: we build a separate HML portfolio for each industry following a paper of Robert Novy-Marx. We're basically just following the Farmer French recipe, but we apply it separately to each of 48 using the market cap of each industry. We then regress HML on this factor, and we call the fitted value HML intra and the residual HML inter. Now, by doing things that way, we have the property that HML is the sum of the two things, and the two things are orthogonal. How's that possible? Well, essentially what we've done is we've credited the intra piece for any component of industry returns that is correlated with the intra-industry return. And then doing things that way, the intra-industry piece accounts for slightly over 70% of the variance of HML. Now, you know, there's other ways you could do this, and we have an appendix where we show you some of those other ways. You could have coarser industries. You could build HML intra by starting with industry demeaned book to market. Or you could do things the other way around. You could invest in value weight industry portfolios using the industry weights of HML and then have intra as the residual. Well, we talk about these alternatives in the appendix and you get broadly similar results. So proceeding with our base approach then, here's the history of the components. I already showed you this figure. And we had observed already that the green line, the intra-industry piece, is a key driver of the big booms and busts in value. When value crashes, that's typically associated with a crash in intra-industry value, and conversely when there's a boom. Okay, now, what if we try to explain these components using the CAPM? Well, you get almost nothing. In our full sample period going back to 1963, the market model regression has an R-squared of 6% for HML, a pathetic 1% for HML intra, and 7% for the inter-industry piece. Okay, now, beyond that, we find that the intra-industry piece is the component of HML that has the strongly positive CAPM alpha. If you want a CAPM alpha, that's the piece, that's the kind of HML you want to buy. On the other hand, the inter piece is the component that contributes most of the negative CAPM beta. It's mostly that the long leg industries tend to have lower betas than the short leg industries. Okay, now there's sub-period results in the paper. I've left them out of the slides and I won't talk about them here. But, you know, here's the CAPM alphas and betas for HML and the two components. And you can see the column headed constant, that's the CAPM alpha. And you can see that it's really concentrated in the intra piece in the middle row. That's where you get this alpha. There's a negative beta, which is the coefficient on RMRF, the excess return on the market, that right-hand column. And you can see the very low R-squared coefficients. All right, now let's turn to the ICAPM. We're cutting to the chase now. What if we apply the ICAPM to this? So what did we find before? In CGPT, we found that HML had a positive cash flow beta. Why? I think the intuition is value stocks are more sensitive to news about current corporate profits, because more of their return comes from near-term earnings. Value stocks have a negative, HML has a negative discount rate beta. Why? Well, the intuition here is that value stocks have shorter duration. Growth stocks are getting a lot of their value from very distant cash flows. So if the discount rate changes, just like a long-term bond, they move around a lot. And in particular, if discount rates, if discount rates go up, then that's really bad for growth stocks relative to value stocks. HML has a negative variance beta. Why? Well, growth stocks have optionality. They are long options. They have options to bring online new technologies, and so uncertainty is relatively good for growth stocks as compared with value stocks, which are mostly about assets in place, so value stocks have less optionality. And then finally, as we've noted, the market beta of HML is slightly negative, which just tells us that the discount rate beta component, the negative discount rate component, is dominating. But putting all of that together in CGPT, where we were focusing on average returns, there's a positive predicted average return to value because long-term conservative investors particularly hate cash flow news exposure and variance news exposure. They don't mind so much about the discount rate news exposure. That's temporary stuff. They don't care that much. But they really hate the exposures where value stocks have more of. That's the way to think about it. So what do we find in this paper, where we're focused on explanatory power? We find that the three types of ICAPM news explain almost half the variance of HML, about 40% of the variance of the intra-industry piece, but not as much, only 13% of the variance of the inter-industry piece. All the components have positive cash flow betas and larger negative discount rate betas, and all the components have negative variance betas. But the positive cash flow beta and negative variance beta are much larger in absolute value for the intra-industry piece, since these are the betas that carry large risk prices in the ICAPM. Qualitatively, this is a good explanation of why it's HML intra that carries the average return. And the results are broadly similar in subperiods before and after 1990. So, here's a table from the paper. The first column is the CAPM beta. Then the second panel is simple regressions. These are what, in theory, matter for pricing in the ICAPM. And then the right-hand panel is a multiple regression where you estimate everything simultaneously. And we report at the right the R squared of that multiple regression, which I've just described. And you can see how the beta DR columns have negative numbers in them, the beta CF have positive numbers in them, and the beta V have, again, negative numbers in them. All right, so let's sort of look visually at what this is saying. The black line is HML. The green line is what the CAPM would predict, what a market model would predict. And the red line is what the ICAPM tells you. So the ICAPM is closely tracking HML during its various booms and busts. You can see the correlation there. That's an R squared of about a half. Okay. But you can also see in this figure that the top panel is the intra-industry piece. That, again, is where the red line is tracking quite well. The bottom panel is the inter-industry piece, and not so impressive. The red and green lines are pretty flat, and they're not telling you why in certain periods inter-industry HML does well or badly. Now we can also ask, well, how does the ICAPM fit HML? What's the story? We can look at the individual components, the contributions of NDR, the green line, NCF, the blue line, and NV, the red dashed line. And this figure is kind of a mess. I don't propose that any story jumps out at it. Why? Because the various cycles of HML have different proximate causes. It's not the case that one thing or the other is always moving it. It's a question of how these different shocks happen to line up in a particular period. So I'll just try summarizing it in words. The mix of ICAPM shocks varies over time. So if you stare at the figure, which I've just removed from your slide, what you see is that in the 1970s, it was mostly about a bad cash flow news for HML. The discount rate news and variance news were actually positive. In the early 2000s, when value did really well, all three shocks were positive. Everything was going in the same direction. And in the 2010s, the lost decade, discount rate and variance news were negative, while cash flow news was neutral. All right. So in the 2010s, the market was rising on strong sentiment. That tends to be better for growth stocks. And there was volatility. The volatility was relatively elevated, and that's also good for growth stocks. But cash flow news was neutral for most of the decade. Now, what I'd like to do in the rest of the time, and I want to be very mindful of the time, is to zero in a little bit on the COVID-19 pandemic in 2020. But to do that, we need a higher frequency model. We're trying to track fast-moving events, so we need a higher frequency. If you try to do it quarterly, in 2020 there were only 4 quarters, and most of the action was in 2 of those quarters, so it's like you have 2 data points. Well, you say, what about daily data? You don't want to estimate a daily VAR. For one thing, you only have daily data for some of the key variables, things like VIX, back to 1990. And low-frequency dynamics need to be estimated over a longer period of calendar time. You need many, many decades to do that. Also, a daily model would very likely need multiple lags. A first order daily VAR would probably not capture all the interesting dynamics. And then you hit the curse of dimensionality. So our solution is to go to a mixed frequency model, and we essentially retain the quarterly dynamics through the vectors, which we've already estimated, which map the shocks in the state variables to the discount rate news, cash flow news, and variance news. These vectors in my notation are lambda dr, lambda cf, and lambda v. So we fix those at the quarterly level. And then we specify an auxiliary daily VAR, which tells us daily innovations in the state variables that enter the quarterly VAR. So the daily VAR contains daily versions of the state variables I've already described, things like the CAPE ratio, the term spread, the value spread, and so forth. It also contains some additional predictor variables that we can measure daily since 1990. So we can take smoothed daily returns, smooth daily squared returns, sort of higher frequency realized variance. And very importantly, the VIX index, which is a forward-looking volatility measure that can tell us exactly when investors perceive risk. Then what we do is we use the daily VAR to calculate every day what are the innovations in the quarterly state variables. So what have we learned today about, say, the realized variance that will be realized within this quarter? Well, if the VIX went up today, we can predict that that realized variance will be higher, so we update the quarterly state variable accordingly. Then, having done that, we multiply through by the lambda vectors and we get daily news terms. So this figure shows discount rate news, cash flow news, and variance news, the green, the blue, and the red, over the whole period since 1990 for which we can implement this daily model. And you can see that over longer periods of time, at sort of the lower frequency, the things are very, very consistent with one another. But the daily model, which is the dashed line in each figure, is jiggling around, bouncing around at a much higher frequency. And particularly in the bottom panel, the red panel, you can see that the spikes in risk are captured much more, that they're much more spiky and sudden in the daily model, because the daily model is looking at the VIX and it's looking at realized daily returns at higher frequency. Okay. Now, let me skip this figure. Let's look at what happened in 2020. Okay. So here we're just zooming in on 2020, and for that 1 year, we're plotting the daily news, which is the dashed lines, and the quarterly news from the original quarterly model, which is the solid lines. The green at the top is discount rate news, then the blue is cash flow news, and the red is variance news. So first of all, you can immediately see why you need a daily model, because if you want to study what happened in 2020, and you were to look at the solid lines, you've got 4 observations. It's much too crude. It can't tell you when things were happening, really. Secondly, you can see that what happened in March of 2020 as the pandemic unfolded was that there was a collapse of sentiment. Discount rates went up a lot, and then there was a recovery. A fairly steep and sharp recovery. You also saw a very bad cash flow news. So investors believed that cash flows were going to take a major long-run hit. And that stayed depressed for a month or two, and then later in the year, perhaps in association with news about vaccine development and other things, cash flow expectations recovered. And then finally, the variance news was a very, very intense spike right at the end of February, beginning of March, and then a relatively rapid normalization. Okay. You observe, of course, that these things in this particular period look very highly correlated. They all seem to be moving together at the same moment. That did happen in 2020. It doesn't always happen, because as I told you earlier, these things, they have correlations, but The correlations are very far from one. But this just happens to be a period when a lot of things happen to all three of these at the same time. Okay, so what does the ICAPM say happened? So the black line is HML, and the green line is the fit from the daily model. So you could see it's capturing the time pattern pretty well. It's not getting the full magnitude by any means, but it's telling you quite a bit about the time pattern of movements in HML, and certainly it does better than a quarterly model would do. If we look at the components, the good fit of the model, the good fit of the green to the black is coming from the intra-industry piece, not the inter-industry piece. So the ICAPM seems to be giving us insights about what was happening to intra-industry value, but not the inter-industry piece. How is that fit achieved? Here are the underlying components. The green line is saying that at the onset of the pandemic, value stocks should have outperformed. Why? Because the rise in the discount rate that drove down the market should have driven growth stocks down by more, and value should have outperformed. On the other hand, the red line is saying that the rise in risk at that moment should have been good for growth stocks. It should have led growth stocks to outperform, value stocks to underperform. It turns out that the green and the red almost exactly cancel. And so we're left with the blue. The blue is the cash flow news. And you can see the blue line and the black line track each other very closely. So in this particular period of 2020, because the other two shocks cancel out, it's really, the underperformance of value is really about the sensitivity to cash flow news. When investors believed profits were down a lot, value underperformed, and then there was some recovery as investors came to believe that profits would recover more quickly than they had anticipated. Okay, so, during February and March 2020, discount rates went up, volatility went up, and later in the year, those developments gradually reversed, but those two effects offset for value. And so it's really all about cash flow news at the aggregate level for HML intra. But we are still left with a mystery, and I just have a little time to talk about that. Why did HML inter also decline and then recover? It did the same thing. Why was that? Well, to understand that, you've got to look at sector-specific earnings shocks. You've run out of road for an aggregate explanation. You need a sector-specific explanation. So basically, what we do in this figure is we plot cumulative scaled earnings for the short leg and the long leg of HML. So the short leg, the red, is growth stocks, and the black is value stocks. So value stocks had flat earnings in 2020. Growth industries had good earnings. And if we, there we go. If we market adjust earnings, then we can see that growth was doing well and value was doing badly. Now, for a more granular look, we can look at industry-specific earnings. In this figure, the horizontal axis is the weight of each industry in HML at the onset of the pandemic. And the vertical axis is cumulative scaled earnings during the pandemic year. And you can see the negative slope of this relationship. There are industries like business services and pharmaceuticals that had very strong earnings for obvious reasons. Zoom and Moderna did great, right? And they were in the short leg of HML. On the other hand, oil in particular had a high positive weight, and it did extremely badly. Now, it's not a completely consistent pattern because banks were long on the long leg of HML, and banks also did pretty well in 2020. But overall, the high growth industries, pharmaceuticals and tech, strongly outperformed. And that is really the story of inter-industry HML in this period. Okay, so I think I've just about run out of time. I will mention that we are currently exploring other anomalies as well, but besides just value. And certainly for some categories of anomalies, these aggregate shocks suggested by the ICAPM seem to have good explanatory power. It works reasonably well, for example, for SMB and for investment-based anomalies. There are others for which it doesn't work very well, like momentum. So it's a mixed picture, but I think an interesting way to think about the nature of risk. So I'm going to finish with this slide. I'll finish with two slides. This one is pointing out that the quarterly ICAPM model is capable of explaining about half the variance of HML with a mix of these different shocks. The cash flow shocks seem to have become relatively more important in recent data, and particularly in the COVID-19 pandemic. This ICAPM story, which is all about aggregate shocks, is a better explanator of intra-industry HML than the movement across industries. If you're interested particularly in the COVID pandemic, sector-specific earnings shocks with an obvious relation to the nature of the pandemic were important drivers. Pharmaceuticals and tech did well, and oil did poorly. So let me just finish with this, which is sort of a return to motivation to leave you with. Last year there was a conference at Chicago Booth about the Chicago School of Finance at 125. And Rob Vishney was in a session on behavioral finance open questions. And he said, what I find lacking is the ability to explain shifts in investor sentiment or valuation dispersion after the fact. Forget about predicting, we can't predict, but after the fact, can't we do better explaining it? And then he talked about what was going on in value in the pandemic and the aftermath of the pandemic. And he said, I'd like to understand that. I'm calling it sentiment, but maybe there's a fundamental explanation. It would be nice if we had some understanding that went with it. And so I hope to have persuaded you in this talk that the intertemporal CAPM framework can go at least some way towards addressing the Rob Vishney's call for understanding of returns ex post in the light of aggregate shocks hitting the economy and the aggregate stock market. So thank you very much.